Okay, so you want to own a private jet company. You picture the tarmac at dawn, a Gulfstream catching the light, a client in a quarter zip stepping off a black SUV with 20 minutes to spare because time, for these people, is the only currency that actually matters. You picture the phone that never stops ringing with people who will pay whatever it takes to skip the line. You picture yourself as the guy who solved that problem for them. Clean, elegant, recession-proof, because rich people always need to fly and somebody has to fly them. Here's the problem. Almost none of that is how this business actually works. What you just imagined is the illusion, the part of the industry built for the passenger, not the part built for the owner. The passenger sees a cabin. You, if you own this thing, see a balance sheet that bleeds every single day whether that cabin is full or empty. Let's start with the numbers that are supposed to impress you. The global private aviation market moves somewhere between $30 and $35 billion a year. There are roughly 24,000 business jets in active service worldwide, and North America alone accounts for more than half of all private flight hours on Earth. Charter and fractional demand has climbed steadily since 2020, as more first-time flyers discovered they'd rather never sit in a TSA line again. But that demand is far more cyclical than the marketing suggests. It tracks corporate earnings, stock market sentiment, and discretionary wealth almost in lockstep, which means the exact moment your typical client's portfolio takes a hit is often the exact moment they quietly downgrade from owning to chartering, or from chartering to flying commercial first class instead. Sounds like a gold rush. Right, now here's the number they don't put in the brochure. Net margins in charter operations typically run between 3 and 7%, not 30, not 15, single digits and on a bad year negative. You're looking at an industry with airline-sized revenue and restaurant-sized margins, except restaurants don't have a $20 million asset depreciating in the hangar next door. And private jet company isn't even one business. It's at least 4 different businesses wearing the same tuxedo, and confusing them is how first-time owners lose their shirts. There's fractional ownership. Think the NetJet-style model, where clients buy a slice of a plane, and the company manages, crews, and schedules it. Steady recurring revenue from management fees, but the operator is carrying enormous fleet and maintenance liability across a huge shared inventory. There's charter brokerage, which is the closest thing to low capital entry in this whole industry. You're not even buying planes. You're arbitraging empty seats and idle aircraft that belong to other operators. Thin margin per flight, but almost no fixed cost, which is exactly why so many first-time entrants start here instead of buying metal. There's Jet Card membership, which is basically a per-paid hours subscription model. Beautiful cash flow up front, because the client pays before they fly, but brutal liability if fuel or crew costs spike after you've already locked in the client's rate for the next 12 months. And there's full-service charter operation, where you own or lease the aircraft outright. Highest margin ceiling if it's run well, highest capital grave if it isn't. Now the part where your stomach drops. To actually put one aircraft in the air as a charter operator, you're not buying a plane and calling it a day. A single light jet used runs somewhere between $2 million and $5 million. A mid-size jet climbs to $6 million to $12 million. A large cabin jet like a Gulfstream or Global can run $20 million to $45 million, and that's before you've touched a single client. Add FAA Part 135 certification, the legal license to operate charter flights for hire, which realistically costs $150,000 to $500,000 in consulting, manuals, and inspections, and 18 months to 2 years of paperwork before you're even allowed to sell a seat. Add hangar space, which in a major metro can run $15,000 to $60,000 a month depending on the market and whether you're getting a covered spot or just ramp access. Add insurance, hull and liability coverage on a single mid-sized jet routinely runs $80,000 to $250,000 a year before you've flown a mile. Add crew, 2 type-rated pilots for a mid-sized jet will cost you $300,000 to $500,000 a year combined. And that's assuming you're not paying signing bonuses in the current pilot shortage, which, by the way, you probably are. Add a maintenance reserve fund you have to seed before you even start flying, because engines don't care that you're a new operator. That's another $200,000 to $500,000 sitting untouched, just in case. And you still need working capital sitting in reserve, 6 figures at minimum, because payroll, fuel, and hangar bills don't pause while you're waiting on your first invoice to clear. Stack it all up, and a single aircraft charter operation needs somewhere between $3 million and $15 million just to open the doors before a single paying customer has boarded. And that's for one aircraft. Most serious operators know a single plane fleet is a scheduling nightmare. One maintenance event, and you have 0 aircraft available, 0 revenue, and a client list quietly calling your competitor. So the real entry cost, if you want a fleet that can actually survive its own maintenance calendar, is closer to 3 or 4 aircraft minimum, which pushes total capital requirements into 8 figures before you've proven the business works at all. So where does the money actually come from? Here's what nobody tells you going in. The thing you assumed was the business, flying rich people from point A to point B, is actually the weakest, thinnest margin layer of the whole model. Per-flight charter revenue looks big on paper. A coast-to-coast mid-sized jet charter can bill $15,000 to $25,000, but strip out fuel, crew pay, landing and handling fees, catering and maintenance reserves, and you're often left with 5 to 10% of that flight actually hitting the bottom line. You just flew a $20,000 trip to clear maybe $500. Say that out loud to someone outside the industry and watch their face. Layer 2 is where it gets interesting. Maintenance reserves. Every serious operator charges clients, or sets aside internally, a per-flight hour reserve, typically $300 to $900 an hour depending on aircraft type, to cover future engine overhauls and major inspections that can run into the millions. Here's the trick. That money sits with the operator, earning float, for years before it's actually spent. Some operators essentially run a mini insurance company inside their jet business, collecting reserves on hundreds of flight hours long before the bill for the overhaul ever comes due, and quietly investing that float in the meantime. That's not flying. That's banking with wings. Layer 3, empty legs and repositioning flights. Every time a jet drops a client off somewhere and has to fly back empty, or reposition for the next job, that's a dead flight, pure cost, 0 revenue, unless you sell it. Smart operators resell empty legs at 25 to 50% off standard charter rates, turning what used to be a total loss into found revenue. This single mechanism can add 10 to 15% to annual revenue on a well-run fleet, and it's basically invisible to anyone who's never worked inside the industry. Here's the catch nobody mentions. You can't build a business model around empty legs because you don't control when or where they happen. It's found money, not planned money, and treating it like planned revenue is how operators overpromise on cash flow they can't guarantee. Layer 4, and this is the one that actually keeps the lights on for a lot of operators: management fees. If you manage aircraft on behalf of individual owners, meaning some wealthy person bought their own plane and pays you to crew it, maintain it, and charter it out when they're not using it, you collect a flat monthly management fee, typically $15,000 to $40,000 per aircraft, regardless of whether that plane flies a single hour that month. This is the layer where owning fewer of your own planes and managing more of other people's planes quietly becomes the smarter business, because you've swapped an asset that depreciates for a fee that doesn't. Layer 5, and this is the quiet one: charter markup on owner-managed aircraft. When you charter out a plane you're managing for a private owner during the hours they're not using it, you keep a cut, usually 10 to 20% of every charter dollar it earns. The owner is subsidizing your fleet's downtime. You're monetizing an asset you don't even own, don't have to insure at full replacement cost yourself, and don't have to sell when the market turns. Layer 6, and this is the one that separates a real operator from a hobbyist. Ancillary services. Fuel reselling at a markup to based aircraft, ground handling fees, crew placement for other operators who are short-staffed, catering commissions, even de-icing in winter markets. None of these show up in the glossy pitch deck, and individually each one looks trivial, but stacked across a fleet flying a few thousand hours a year, ancillary revenue can quietly add another 5 to 8% on top of everything else. And unlike charter revenue itself, almost none of it is exposed to fuel price swings. This is the layer that turns a break-even operator into a mildly profitable one, and it's the layer most first-time owners don't even know exists until year 2. Here's the insider trick almost nobody outside the industry has heard of: dry leasing and depreciation arbitrage. Aircraft have historically qualified for accelerated bonus depreciation, allowing an owner to write off a huge chunk of a jet's purchase price against taxable income in year 1, under the right business use rules. Operators structure deals where a high net worth client technically owns the aircraft, capturing that depreciation against their own income, while the operator manages and charters it under a dry lease, collecting management and charter revenue without ever carrying the asset on their own books. The plane's tax benefit belongs to the rich guy. The operational cash flow belongs to you. Nobody loses, except maybe the tax authorities, depending on how aggressively it's structured. And that's exactly why this mechanism gets more regulatory scrutiny every few years, and why the rules around it keep tightening. Then there's the bleed, the part of the business that has nothing to do with flying and everything to do with the calendar just quietly taking your money. A single mid-sized jet, sitting on the ground doing absolutely nothing, still costs you somewhere between $400 and $900 a day in hangar fees, insurance carry, financing interest if the aircraft is leveraged, and scheduled inspection amortization. That's before fuel. That's before crew salaries, which run whether the plane flies or not because you can't summon a type-rated pilot on 4 hours' notice. You're paying them to be ready, not just to be flying. Add software, scheduling, flytops compliance, weather and dispatch systems typically run $2,000 to $8,000 a month per aircraft. Add recurrent training, pilots have to requalify on the aircraft type every year, and that's another $15,000 to $25,000 per pilot per year, whether you like it or not. Here's the trap: none of these costs care whether you had a good month or a dead one. The plane doesn't know it's January and charter demand just dropped 40%. The lease payment still hits on the 1st. This is a business where the clock itself is a line item. And every year, insurance renewal comes with its own gut check. Premiums move with claims history across the entire industry, not just your own record. So a competitor's accident on the other side of the country can quietly raise your rate. You're also, in practice, locked into a handful of maintenance vendors who are authorized to service your specific aircraft type, which means you don't get to shop around the way you would for, say, a fleet of delivery vans. Here's the trap nobody frames honestly. The more specialized the aircraft, the fewer people qualified to fix it, and the more leverage they have over what they charge you when something breaks on a Friday afternoon. And that brings us to the structural risk, the one domino that can take the whole model down. It's fuel and financing correlation. Most charter operators run on financed or leased aircraft, meaning debt payments are fixed, but jet fuel prices are not. They can swing 30 to 50% in a matter of months on geopolitical shocks alone. When fuel spikes, you can't always pass the full cost to clients mid-contract, especially jet card holders who locked in hourly rates months earlier. So you're stuck absorbing rising variable costs against fixed debt obligations on an asset that depreciates the moment you take delivery. It's not bad luck when this breaks a company. It's baked into the architecture from day one, and every operator knows it's coming, they just don't know when. Which brings us to the case study. And there's no better one than Wheels Up. Founded in 2013, It built its whole pitch around democratizing private aviation membership fees, guaranteed availability, a slick app. The whole Silicon Valley veneer stretched over a 100-year-old industry. It went public in 2021 via a SPAC merger at a valuation north of $2 billion, riding the exact fantasy this video opened with. And then reality did what reality does. The company was burning through hundreds of millions of dollars a year, fleet costs, crew costs, fuel volatility, and a membership model that priced flights below what it actually cost to fly them, which is about the fastest way to scale a company straight into a wall. By 2023, the stock had collapsed more than 90% from its SPAC debut, and Wheels Up was staring down a genuine liquidity crisis. Delta Airlines, which already held a stake, stepped in with emergency financing and effectively took operational control, later folding much of it into a joint venture. The lesson isn't that private aviation doesn't work. The lesson is that scaling the fantasy faster than you scale the unit economics is how a $2 billion company ends up needing a bailout from an airline. So how do the smart players actually win in this space? Almost never by owning the most planes. The operators who print consistent money run asset-light management businesses. They manage other people's jets for fees and take a cut of charter revenue without ever carrying the depreciation and debt themselves. The truly wealthy players don't even think of the jet as a profit center at all. For them, it's privacy, time arbitrage, and a fractional ownership tax structure, where the return isn't cash flow. It's simply never having to sit in a TSA line again. And the big fractional players, the NetJets model, win through sheer scale. Hundreds of aircraft pooled across thousands of owners means they can absorb one bad fuel quarter or one grounded plane without the whole operation flinching, something a 5-jet operator simply cannot survive. Scale here isn't a vanity metric. It's the only real insurance policy this industry has. There's also a quieter play that's picked up steam over the last several years: private equity roll-ups. Instead of building a fleet from scratch, sophisticated investors buy up several small regional charter operators, each already holding its own Part 135 certificate, its own client base, its own crew, and consolidate their back-office costs, insurance, and fuel purchasing power under one umbrella. You're not paying to build certification and reputation from zero. You're paying a premium to acquire it already built, and then squeezing out margin through scale that none of the individual operators could access on their own. It's a less glamorous strategy than buying your own Gulfstream, and it rarely makes for good content on a founder's LinkedIn page. But it's a far more repeatable path to actually making money in this industry than starting an operator from a single aircraft and a dream. Now let's put real numbers next to each other. Goodyear, a mid-sized charter operator running 6 aircraft, strong empty-leg resale, healthy management fee contracts, fuel prices stable. You're looking at $18 million to $24 million in revenue, with net margins landing near 8 to 10%, meaning $1, $5 million to $2, $4 million actually hits the owner's pocket. Bad year, same 6 aircraft. Fuel spikes 35%. One plane goes down for an unscheduled engine overhaul costing $600,000, and 2 major corporate clients cut travel budgets during a downturn. Revenue drops to $14 million, and margins go negative, somewhere around -2 to -5%. Same fleet, same brand, same crew on the payroll. Either way, completely different year, and the difference isn't incompetence, it's exposure. So is it worth it? Depends entirely on which layer of this business you're actually in. If you're trying to be an old-school full-service charter operator buying and financing your own fleet, this is one of the most capital-intensive, thin-margin, structurally fragile businesses you can enter, and it will quietly bankrupt operators who mistake revenue for profit. If you're running an asset-light management or brokerage model, collecting fees on other people's aircraft and reselling empty legs, this can be a genuinely strong, scalable cash business, with far less exposure to the parts that actually kill people in this industry. And if you're the wealthy individual buying a fractional share purely for your own use, You were never really running a business at all. You were buying yourself time, at a price that only makes sense once your hourly rate already exceeds what the jet costs you. This industry rewards patience and structure far more than it rewards ambition. The operators who last a decade are almost never the ones who opened with the biggest fleet and the flashiest livery. They are the ones who started small, kept fixed costs low, treated management fees as the backbone of the business instead of the afterthought, and only leaned into ownership once the fee-based revenue could carry the fixed costs of an actual aircraft. Everyone else is one bad fuel quarter away from becoming the next cautionary case study. The private jet was never really the product. It was a machine for converting other people's fixed costs into your flexible time, and whoever ends up holding the fixed cost is the one who actually loses.